Hello, this video is a tax update over the dividends received tax break. I'm your professor, Dr. Stephen Haggard. The Tax Cuts and Jobs Act of 2017 changed something that had been relatively the same for many years, and that was how companies handle their dividends they receive for taxation purposes. Let's talk about philosophically why a corporation should not have to pay taxes on dividends when an individual does. At first, this sounds like some corporate fat cats getting by with something, but in truth, it's just an interesting thought about how we get taxed in this country. So we have what is called single taxation for sole proprietorships and partnerships, and that's where all the profit is taxed as personal income to the owners of the firm. Now, when you get into a corporation, though, we have corporate taxes, so that's like income tax for the corporation, and then when they pay out dividends to the recipients, the shareholders, those people must also pay taxes on those dividends, and so we have double taxation. Apparently, double taxation is okay with the United States government, but triple taxation is not, which is why we have the situation we do with the dividend exclusion. Here's the example. If Company A owns shares of Company B, when Company B makes $1, they have to pay corporate tax. Let's say it's 21%. That leaves 79 cents of that dollar left over. Now, if they pay those dividends to Company A, and Company A also has to pay taxes, there's an additional amount of tax taken out, and then when Company A pays a dividend to their shareholders, now we have triple taxation. And so we're trying to avoid that. And we used to have the situation where at least 70% of the dividends that were paid to a company were excluded from their taxable income. However, we now have the situation where only 50% is excluded. That's because of the Tax Cuts and Jobs Act of 2017. So in fact, this part is not a tax cut, it's actually a tax increase. Now, the good news is you can still get by without paying any taxes on the dividends received from other corporations if you're a corporation, if you own 80% or more of the stock in the company that's paying the dividend, because then you can just file consolidated taxes for the two entities, and basically any transfers between them, including dividends, would just be considered intra-company transfers and would not be taxable.